Robert, did you just leave me?
No, I'm here.
Uh-oh. Okay, good. Oh, I saw a little blink. Sorry about that. Okay, so we're actually going to kick this shindig off. Welcome, everybody, to the budget session here. We're going to be talking today about budgets, all that fun, wonderful stuff regarding association budgets. Budgets, for those of you who haven't recognized my voice or don't know me, my name is Paul Petrulis from Associa Gulf Coast. I am a licensed manager here at Associa Gulf Coast. I'm also the business development director, and I'm certainly thrilled that you're all joining us today. We have roughly about 35 people on the session right now, and it'll slowly but surely build more. We did have about 85 people commit in different stages for the session, so hopefully you get a lot of good information today. This session is recorded, so you can feel free to take notes if you'd like. There will also be some attachments and other documents that will be emailed out to everybody at the end of the session. Not a problem. Don't worry about writing anything down. You will get all the information as well, including as we go through the slides today, the individual speaking, you'll be able to not only see their picture, but all their contact information will be on the screen in front of you as well. So without further ado, you know who I am. I'm going to introduce who actually will be talking and discussing certain things today. And here we are, these fabulous, this motley crew, if you will, of industry professionals. We have Sheila McKenna from Centennial Bank talking to us about some financial challenges and some financial information regarding budgets. Robert Mitchell from Mitchell Insurance Services. He's going to be talking a bit about how insurance impacts the budget. Obviously, now we have Matt Kuisle from Reserve Advisors, and Matt's going to talk about the importance and basically what a reserve study is and the importance of it, and Michael DeMare from AffinityCPA, because we can't talk about budgets without having the accountants represented here. And again, my name is Paul Petrulis from Associa Gulf Coast. There's my ugly mug, so thank you for that. I have a little bit less hair now, so I'm in much better shape, and I haven't worn a tie in God knows how long. I've been here in Florida for 3 years, and I think I wore that tie 3 years ago. So that being said, I'm going to kick this off before I pull in the speakers today, and just talking in general terms about budgets and how they work in the association space. Here at Associa Gulf Coast, we believe that budgets are year-round exercises. They are not, or let me rephrase that. You will hear from time to time that the budget season starts in July and August, and the budgets are submitted to the boards right around Labor Day. That's a very good framework in terms of time, and the reason we use that framework for starting the budget season is because typically we want 6 months of historical data, the most recent historical data for the expenditures of the association that we can then use to project out not only the rest of the current fiscal year, in this case 2020, but also use that as the most recent solid data to then start looking at 2021's budget for your respective association. So budgets do not just all of a sudden stop. They are fluid, they are not set in stone, but they have a lot of different components to it. And I want to start off with the reserve study. Now, what I mean by that is there might be some people on the phone and on this call that, quite frankly, have never heard about what a reserve study is, might not know what it is and the importance that it has regarding your budgets. So I'm going to bring in Matt Kuisle from Reserve Advisors. Matt, if I could you give me just let's just say 20, 30 seconds on what a reserve study is, and then I'll start picking you apart and asking some questions as how it's going to relate to budget.
Yeah, sure. Happy to. I'll give you a high level. It's, a reserve study is a planning tool primarily, and it's both a physical or engineering analysis and a financial analysis. So it's kind of two studies in one. The basis is always the physical engineering side and what the community has, how long things are going to last, and how much they're going to cost to replace. And then from there, the study tries to answer the question, how much do we need to set aside on a monthly basis to avoid a special assessment or to fulfill our fiduciary obligations of having a fully funded budget.
Perfect. So, and really do appreciate that 5,000-foot view. And right out of the chute, as I had anticipated, we got the first question about a reserve study. And the question is, it's going to be about, actually, I take that back. It's about reserve schedules and pooled reserve. So Mr. O'Connor, I'm going to pull your question in here in just a minute here. But talking to Matt, talking about reserves and reserve studies, obviously that equates to long-range planning, 5, 10, 15, 20 years down the road. Is a reserve study, let me rephrase that, does the board have to, once they've established and they've received a reserve study from a firm just like yours, do they have to follow it? Is it something that is set in stone that the board is then required to follow?
No, it's not. And there's actually very few statutes or requirements revolving around studies itself. But that being said, there is what we call the good business judgment rule, and that is something that we do have to follow. So if you were to say get a study from a professional and it said your roofs were going to be $100,000, let's say, it would not be prudent for you to go and put in your budget that the roofs are going to cost $20,000 unless you had some other good reason to believe it wasn't correct. So it's a little bit of a softer rule. It's not set in stone, but I think if you for any reason would not follow it, you could open yourself up to a claim from someone that said you didn't use good business judgment by listening to an expert on what the item was. So whenever I get the question a lot, do we have to follow it, or your recommendations are much higher than what we were expecting? We can go through, and there's many things that we would be willing to change in a reserve study. Nothing is set in stone, so we're usually willing to work with a board or a community to make sure that the study tailors what they're trying to do. But at the end of the day, we have to make sure it's realistic and that we're not misleading the membership into thinking our roofs are going to cost $1 amount when they're actually going to cost a different dollar amount. It's all about disclosure to our owners and make sure that we've got the right items in the schedule, the right costs, and the right times.
Completely makes sense. Now, that also brings up a different direction of this, and that is, are there any requirements? Is there anything in the statute that says that an association, be it a condominium or an HOA, is there any legal requirement that association must have a reserve study? And if there is there any timelines around those studies?
No, there's no requirement to have a reserve study except at turnover of a condominium association. There are in the required disclosures for a developer, there's some reserve information that the developer has to turn over to the board. But other than that, after a community is turned over, there is no statutory requirement to do a reserve study. It is really a best practice for communities to do it. Each board has to set a budget, and they are required to set the reserve schedule and put the number out to the membership to understand what the items are. For a condo, it's roofing, paint, paving, and anything else over $10,000. So we want to make sure we've got all those items covered and disclosed to the membership. But a board could do it themselves. Just best practice for professionals to make sure that we're not missing anything.
Excellent. I'm sure a question just popped up here regarding how much does a typical run-of-the-mill, and I know it's a bad question to ask you, Matt, but typically speaking, what's the range for how much a reserve study costs? It's a natural question. Just generally speaking, how much could an association expect to pay for a reserve study?
Sure, it kind of depends on, obviously each association is different, so I'm going to sound like an attorney here, but it's going to depend on each property. The location, the age, the amenities, the size of the property all have a factor on how long our consultants, and we use our own team of engineers, how long they're going to spend on the project. Generally, I believe our average fee is somewhere around $3,900 to $4,000 for like the average. If we look at the large pool of clients that we have in Florida, that's probably the average fee, but certainly they could be much less or much higher than that. And then, generally, again, updates cost less than the initial study, where the engineer has to do all the initial legwork, do the measurements, and get all the initial quantities of everything that you have there. It just takes a little bit of extra time.
Perfect. I'm gonna stick with you, Matt, for this next question, and I'm gonna pull Sheila into this, but the question, it's regarding pooled reserves. And the question is, this is Mr. O'Connor's question. I was recently told that LCAMs were not allowed to be involved in the pooled reserves and that only CPAs could prepare pooled reserve schedules. Now, that's a statement, but Mr. O'Connor brings up a question about pooled reserves. So I want to talk to you, Matt, briefly. What is a pooled reserve versus a straight line reserve? And quite frankly, should an association have them?
Great question. We get a ton of questions about this. In Florida, a little bit of history, Florida is unique in up until 2003, they required a segregated analysis of each item, meaning they actually required straight line reserves or component reserves, which is basically a straight line depreciation of each item, and each set of money was kept in its own bank account, roofing, painting, paving, and they could not be commingled or used for any other than their intended purpose. The statute still reads similarly, but in 2003, the administrative code was changed, and the statute changed slightly to allow for grouping of assets, which is commonly called as pooled reserves. So now, instead of having segregated reserves for your roofing, your painting, your paving, etc., you can have one reserve for all of the items in the schedule. There are a few reasons that associations do this. Actually, majority of our associations are migrating towards pooled reserves. I'm sure Mike and Sheila and others may be able to comment on this too, but we're seeing a lot more communities using pooled reserves for two primary reasons. One, it gives the board some flexibility. As good as we are at estimating times and costs of replacements, if something's underestimated or one category falls short, with a pooled reserve, it's less critical and causes less issues. Usually able to spend the pooled reserve, overspend in one area or overspend the pooled reserve according to the plan, and then build it up the next year without having to get member approval. So it gives the board some flexibility. You still can't spend money on anything outside of that group of elements. So you can't spend, you can't add anything to the pooled schedule and say, okay, this is our reserve, or we're going to spend money on that item, even though it's not in our pooled reserve. So it is restricted to that group, but it's not restricted within the individual components within that group. So that flexibility is appreciated by a lot of boards. And then another reason, maybe a bigger reason that associations are migrating towards pooled reserves and having them, is that it usually results in a lower required funding level to keep the reserves fully funded. And this is a little bit hard to explain in a format like this, but suffice to say, if we did two side-by-side comparisons, 95 out of 100 of those comparisons would require a higher contribution level for individual components than they would for pooled reserves. And the main reason is that we're looking in the pooled reserve, taking advantage of cash flow and the fact that you're not spending all of the money at the same time. You're spending, one year you're doing the roofing project, a few years later you're doing painting. Not everything falls at the same time, so it allows you to run with slightly lower balances at any one point, which results in lower contribution levels needed. So side-by-side comparison, it's usually a lower monthly assessment if you can go to pooled reserves versus component reserves.
Absolutely makes sense. You bring up something fully funded. Now, those of us in the industry, we hear that quite a bit. With regarding reserve studies, and then certainly the reserve component of budgets, unit owners, if the board submits a budget that they are suggesting or recommending that is not a fully funded budget, the unit owners have to vote on that. That is not just a board component. The board submits a budget to the association unit owners that is fully funded, and that's it. There's no need for the unit owners to engage this. On the other hand, if the board does not want to fully fund and they're making the recommendation to, let's just say, fund the reserve at 50% of the projected cost or the projected commitments, that will require a unit owner vote. Am I explaining that correctly?
Yes, that's consistent with my understanding of that as well. And it gets a little bit complicated. I see there's a question about 720 any HOAs in the chat here. So when we're proposing that fully funded budget, I guess that's all I propose. When you're proposing the fully funded budget, it really is only for your statutory items. So you might have in homeowners association, you might not have a requirement to have reserves. You only have to have reserves in a homeowners association. The developer established them prior to turnover, or it's required in your documents, or if the membership voting interest voted to establish a reserve account. Condos is very different. Condos, you have to have reserves for roofing, painting, paving, and any other expense over $10,000. Any co-ops, 719 associations that we have on the call here as well, your requirement is similar to condos. And so, yes, you have to propose a fully funded budget, including roofing, painting, paving, anything else over $10,000. For an HOA, you may not have any reserve accounts that are statutory that you have to propose in your budget.
Perfect. Now, Mr. Jerome actually has two questions back to back in this scenario. It's how often do you need to update the study if you have one? And then from that pooling reserve perspective that you're talking about, can you add items into the pool?
So I would say, you know, get different responses from this, and of course you got to consider the source when I'm telling you this. Reserve studies don't need to be updated every single year, I don't think, professionally. We do have a number of communities that like to get professional input each year on what costs change and et cetera. And so there certainly is a group of communities out there that do that and benefit from it. But I really think in our industry, most communities, if they're updating on a 2 or 3 year cycle, they're doing fine. Now, you still have the requirement that you have to put together the budget each year. So if there was a large change in costs, or if something dramatic changed in the community, and the board or the management didn't adjust for that in their budget, that could certainly open them up for a claim, you know, or just they could be not following their full responsibility. So, you know, it's not a bad idea, especially for a larger community that has a lot going on, to take a look at this or have the professionals in every year. As a board, you have to look at it every year as a part of your budget. And then what was the
Perfect.
second?
And it was, can you add items into the pool of the pooled reserves?
You can, just as you can add items on your component list as you identify them. But what you can't do is mid-year say, okay, we don't have the irrigation system on the schedule, but we have an irrigation system repair that we need. We can't spend the pool money until we actually get irrigation on the in the schedule, which would mean either a ratified budget or waiting until the next fiscal year and putting a new budget together that had the irrigation system in it. And now that opens up the pooled funds for irrigation system. But the schedule has to reflect the anticipated expenses for that item in order for the funds to be used, the funds to be used for that item. If that makes sense.
It absolutely makes sense. So now I'm going to pull Sheila into the conversation from Centennial Bank. Obviously, we're kind of wrapping up the reserve study piece of this, but we're going to bounce back a little bit here and there. But from a banking perspective and a budgetary perspective, why are reserve studies so important? I mean, when it comes to doing budgets, from a bank's perspective, why do it at all? What makes it so important for the association?
Well, I think I'll get a lot of agreement here from the panel that one of the major issues for board members is really explaining and communicating and helping the membership understand why they're doing the things that they need to do. You know, owners for the most part understand that they have to mow the lawn, they have to clean the pool, but when we start looking at roofs and painting and restoration, you know, some people have different priorities and they're going to give you pushback. It's just human nature. So a reserve study can help them understand why you're getting into a specific project. The bank can look at the reserve project, reserve study in case you need to make up for a shortfall with a loan. I kind of like the analogy I heard about a reserve study, and that is, think of it like a road trip. All of us remember having paper maps and taking the wrong roads and taking the wrong off-ramps, and you will eventually get there, but it will take you longer. It will cost more money, and by the end of the day, nobody's talking to each other. So a reserve study is kind of like a GPS, where you're going to get there faster, you're not going to be making as many mistakes and have to turn around, and you know what your costs are going to be. So from the bank's perspective, the reserve study specialists do a great job of, assessing the conditions of the buildings and looking at costing and what that's going to cost over the lifetime of the association there. But I think that the bank is a great asset when we start talking about where are we going to take this money and put it so that we have cash flow for projects when we need them, but we also consider, yield, what we're going to make on it, liquidity. Are we going to put this into a money market where we might be making a lot of withdrawals in 1 month and the limit is 6, or most importantly, safety? Are we going to be having a large amount of money and not have it insured by the FDIC? So I think that the bank and the reserve study specialists work together to be part of the team for the association.
Absolutely makes sense. Now, talking about, you brought up investments, those types of things. Some associations have these, other associations don't. What I'm talking about is an investment policy as it would relate part first or second, but what should the managers and boards, when they're starting that budget process, how does banking play a role in that process when your board and your managers are, sitting down at the table at that first go round and go, all right, here we are, we're creating that budget, we're starting along. How does banking play a role from your perspective, Sheila?
Well, I think that banking plays a role in making sure that the funds are in the correct type of account, that funds are sweeping in and sweeping out of accounts as they're needed, that the bank can sit down and look at what they're trying to do and say, you're not going to need this roofing money for the reserve for at least 5 years. Why is it sitting in a account? And so I think the bank is a great partner there to make sure that the money isn't earning less than it should and not working hard for the association. And we can look at those budgets and say, you put a lot of money over here in painting, and is that really going to be the right kind of account for it to be in? I would say from the account perspective, that's where the banks will really help you make sure your money is working harder.
100%, completely agree there. I want to bring in Robert Mitchell from Mitchell Insurance regarding how insurance is a huge portion of association, not only their budgets, but their expenditures. And for those of us like me who have only been here in Florida for about 3 years and had to deal with that little rainstorm called Hurricane Irma, I think some of us are still dealing to a certain extent with some damage and some insurance claims and those types of things, because I understand that the timeline for those commitments is rapidly approaching, or the deadline, I should say, is rapidly approaching. But Robert, when we're talking about insurance, the planning of it for next year, depending on who you talk to, there should be some projected increases in premium costs. And I know nobody likes hearing that, but let's talk about reality. Robert, when it comes to the different types of insurances and different policies that's available to associations, how do you see the upcoming fiscal year of 2021, that next budget cycle? Where do you see premiums headed, if you will?
Yeah, unfortunately, this year we've been dealing with a ton of uncertainty, not only with COVID, but just in the market in general. And so what we're advising our associations is for the property insurance on average, and I try to give a higher budget number in terms of increases. We're thinking on 20%, or at least we're advising our clients 20%. For the general liability, we're advising our clients around 15%. The flood, on average, we're advising around 10%. And there's a multitude of factors that are compromising these recommendations. First and foremost is the year 2017 and the storm season that we had. Obviously, we were all here and dealt with Irma, but that storm season was actually the costliest season in recorded history, and it was $45 billion more expensive than the previous costly season in 2005, which had Katrina in it. And so, first and foremost, we're having an uptick in storms between 2017. The Irma estimated losses are going to be around $25 billion in Florida alone. 2018, we had Hurricane Michael, which was, at the time around $7.5 billion in estimated losses. Then last year we had Dorian and some of the other storms that they were ballparking around $13.9 billion. So we had a good stretch between about 2006 to about 17, where we had an 11-year period where a major storm didn't make landfall. And if you were on the book at the time, specifically probably around 2009, 10, 11, that's when premiums started to decrease. But we're entering in what's called a hard market now, and the hard market means that pricing for us, the consumers, is going to be on the rise. And so it's not only the storms that we're running into as an issue for this driving factor, but Florida is ranked number 47 in terms of poor legal environment. The number of lawsuits that associations are facing, as well as insurance companies are facing, has gone up tenfold. From 2013 to 2019, property insurance companies have seen an increase of 96% in the number of lawsuits that have been filed against them. And from an association standpoint, I'm sure many of you have seen them, but we're starting to get all of these subrogation demands or subrogation notices that allege the association was negligent in their maintenance of the building, and it led to a unit owner having damage within their unit. And the insurance company that handles the unit owner's policy, they're now demanding that the association pay for it. So that's a new phenomenon that's been going on over the last few years that's caused the general liability market to shake up. And we've seen a number of companies either just get out of the general liability market altogether, or they've restructured their price points to where that's gone up rather significantly compared to years past. And then we got flood insurance. I mean, flood insurance is kind of the one that's not talked about right now because we're just so used to having the flood insurance premiums go up. So what we have is the federal government running a deficit, and they've been running a deficit since Hurricane Katrina and the flood program. I think right now it's around 24, 26 billion. And so what they've been trying to do since essentially 2006 is reform the flood insurance program, adjust the rates to where they increase on a sliding scale year over year based on your risk factors. On average, FEMA is saying about 9.9%, but if we're pre-firm or if you're in a higher risk zone, you're facing potentially a slightly higher increase. So we're kind of in a perfect storm of uncertainty, factors that have been leading up to increases for years, and the COVID was just a grenade that is just shaking this market up substantially. And so over the next year, more so this year than in years past, we really need to keep our fingers crossed and hope that we don't have a major storm make landfall, because there's a lot of insurance companies in the state here, not so many that do the master policies for associations, but on the personal line side specifically, they're kind of running on fumes, and if a major storm comes, then the solvency of those carriers may be proven to be difficult. And if that happens and carriers start going out of business, it could shake up the marketplace as a whole.
That absolutely makes sense. And I see a couple of questions coming in, and I'm going to get to those here in a second. We're living in a very weird world right now with COVID-19, which has effectively upended just about everything that we do in all forms of life. Well, we recognized when Hurricane Irma hit, and when I say we, I'm talking Associa Gulf Coast and the management agent side, is that there was a lot of unknowns or uncertainty from the regular regular condo association coverage versus named storm coverage, and the assumptions that deductibles were going to be met when in fact that they weren't. That was something that we uncovered, and we learned a little bit more, and then we educated our clients as best we possibly could. Talking about the world that we live in now with COVID upending everything, Robert, what do you see on the horizon, so to speak, when it comes to insurance that people just don't really think about? And where I'm really going to that is cyber insurance is certainly something that associations need to be aware of. And is there any kind of a policy or an exclusion or something like that that could be related to something like this kind of a pandemic? Is there anything out there that people need to be aware of?
Sure, yeah. In the general sense, this type of pandemic is not a covered cause of loss. Your standard general liability insurance policy has what's called a communicable disease exclusion. And so that was one of the big things that we were dealing with, at least at the start of this pandemic, with all of our associations, was whether or not to keep the common amenities open. Because especially early on, there was so much uncertainty. And I feel like we're learning more every day. But there's still a lot of unknown, like you mentioned, Paul. But as a scenario here, if someone gets COVID, and they may not really know where they've got COVID from, but they know that they have medical expenses and they don't have any health insurance, they're trying to think of a way to potentially, get these costs paid for. In scenarios like that, we oftentimes find that those folks trace back their steps to whoever's got the deepest pockets. And a lot of times the association will have the deepest pockets because they have the insurance policies and they have the financials back. So what we're concerned with were folks trying to allege that our associations were negligent, and the reason why they actually got COVID was because the proper cleaning processes weren't in place at the clubhouse, or social distancing wasn't being enforced at the pool area. And that's the same concerns that a lot of businesses are having to face as they reopen, because there's, as it stands right now, no liability protections for businesses or associations if someone makes that allegation. Now, is that going to be hard to prove? Absolutely. And the likelihood of one of them, actually transmitting the disease at a property, especially if you've taken the proper steps, is minimal. But because of that exclusion, it's still something where the defense cost would be out of pocket. And so they do have a policy out there. It's called a legal defense gap policy. It's designed to pay defense costs for any lawsuit that's brought against an association that your general liability or your directors and officers liability policy won't cover. So that's been something that we've been discussing with our associations more. Cyber liability, as we move forward into more and more of a digital age, it will become more and more of an exposure for associations. It's an extremely inexpensive coverage. I mean, anywhere from $500 or anywhere really $250 to $1,000. And a lot of times your directors and officers liability policy will include some type of supplement on that. And then just touching on what you mentioned about the deductibles and what we found out with Irma. Insurance companies are getting more and more creative with how they structure their deductibles. And so when you're working with an agent, by employer, make sure that you have complete trust and faith in that agent, and they're presenting you with a policy that is going to be comprehensive, and they're going to make you aware of the different deductible standards. Because like Paul mentioned, you have a hurricane deductible, you have a named storm deductible, you have wind and hail deductibles, you have per occurrence minimums, and all of these different deductible structures could potentially lead to higher out-of-pocket expense for the association.
Now, I do want to, you're 100% right. That totally makes sense on my side of it as managing agent. But one thing when it comes to insurance that I think tends to get lost in the shuffle is, and I'm speaking directly to the board members on the call. Managing agents, and it doesn't matter if you're an associate client, if you're working with other terrific firms, that's not where I'm going. What I'm saying is, we as a managing agent, we are not insurance people. We do not, your licensed manager, unless they have an insurance license, they aren't qualified to discuss in any level of sincerity and legally, quite frankly, your insurance policy. So I would implore you, the board members on the call, please, yes, ask your managing agent about going out to bid. Ask your manager about, did they get the documents? But when it comes time to explain those documents and explain those policies, I'm going to make a blanket statement. Robert, help me if this is wrong. The manager is not qualified to truly discuss your insurance policies with you, the board. Am I explaining that properly, Robert?
Yeah, that's 100% correct. Managers have a CAM license. We have a 220 license, and we have to take a test specifically for insurance at the state level to even go out and ask folks to buy insurance. And so you should be talking with your agent directly. You shouldn't be relying on the property manager as an intermediary, because while they might be a very good property manager, likely have a little bit of knowledge on insurance, but they don't have the nuts and bolts knowledge that you would need to really understand what you're purchasing.
Excellent. Now, and one more question on the insurance side before we're going to move over to Michael on the tax side of this, CPA side of this, is about the due diligence. Mr. German submitted this question. If the association is doing their due diligence in terms of going out to bid, from the agency side, what's the due diligence perspective of you, the agent? So if I'm happy to HOA and Robert, you are representing us in the insurance world, how often, not only should our policies be reviewed, but how often should we go out to bid for those?
Well, each association is different. What I typically recommend someone go out to bid. If you're working with an agent who you trust, you have faith in, then they're going out to bid for you every year after renewal. See, there's a misconception on how insurance is purchased because you have the Geico Get, the Name Your Price tool from Progressive, and folks think that you can just go online or you can go talk to 4 different agents and they can all bring you a quote and tell you what coverages are. And I hear this all the time. We just want to make sure it's apples to apples. Well, unfortunately, when you're talking about condo insurance specifically, it's harder to do that because the insurance companies that do write condo business, they operate on a first come, first served basis with the agents that represent them. So if I'm your agent and if the underwriting window opens up 125 days or 120 days from the renewal date, then I'm making sure that I get all of your applications and surveys over to the insurance company at 120 days, because that then puts me in line for the underwriter and are able to have them review, get the pricing, get the quotes back at a more expeditious level. Now, what that also does, it also blocks another agent from trying to get a quote from that specific company, because, like I said, these insurance companies typically work on a first-come, first-served basis. Now, when you're talking about getting competitive bids, once again, I try to tell my associations not to look at it strictly from a price point. I understand that price is obviously a large factor when you're purchasing insurance, but I try to say, hey, take your price hat off for a few minutes, interview the agent, listen to what they have to say, see if they're knowledgeable about the specific type of insurance you're needing to purchase, and see if their service platform is going to be one that you think is going to be conducive to a long-term relationship with the association. So, as your agent, what I do that's a little bit different from a lot of my associations is I do comprehensive policy reviews. I'll do an on-site survey of the property to see if there's areas where there's higher loss potential, and then we put that together and we make a conscious effort to try to minimize claims over the course of the year, because that way at the time of the renewal, when we have a clean loss history, we're going to be more favorable in the eyes of the insurance companies, and they're going to be able to give us a better rate, or we're going to have opportunities with insurance companies that might not have wanted to insure us, which once again will give us a better rate because we have multiple companies that are competing against one another. And so that's what we try to do on the agency side. From an association standpoint, all I can say is do everything within your budget to keep that association up to date as good as possible. Deferred maintenance and prolonging updates, specifically roof updates. Those are the factors that I see, in associations that are paying significantly more than some of the others.
And one thing to kind of tie this into your reserve study, if you have significant roof damage from the insurance side and you file a claim, if you had a reserve study before then, and then you file the claim and then you have a new roof, it does make sense to then have, in this case, reserve advisors come back and rework the numbers so that, because now you have a new roof, your reserve contribution numbers are going to be changed or skewed after those significant repairs are made. So thank you for that. So now we're going to move a little bit over to it. And I hate to do this to you, Michael. The most exciting part of this session is accounting. Woohoo! CPA stuff.
That's for last.
But it is but it is unbelievably critical when it comes right down to it. Now, I'm going to use this as a simple example again. Whoever's listening, your current property manager, whoever it is, your association manager, they're not a CPA. Even with Associa Gulf Coast, the chances are your manager is not a CPA. We have resources to help, but ultimately we aren't CPAs. We're not going to understand certainly the legalities and the tax codes, if you will, like somebody like Michael here, who can explain everything a heck of a lot better than us. I like to use the example, us as Associa Gulf Coast, when we have a question about accounting and taxes and those types of things, we want you to engage your tax accountant, someone like Michael, to get the better answers. Even though we have resources, we want to bring the professionals to the table. Now, that being said, bringing people to the table, we're going to talk a little bit with Michael here about the engagement level of the board and specifically the treasurer about the creation of the budget. So, Michael, if I could you kind of walk us through your view of how important it is for, whether it's the full board or at the very minimum the board treasurer, their level of engagement in the creation of the budget?
Yeah, thanks, Paul. Yeah, and I'm speaking as CPA, but also as a treasurer of a condo and a homeowners association. To expect the manager to put together the budget and then just to sign off on it with minimal input, I think that really does a disservice to everybody, to the board, to the manager, and to the owners especially. The managers, they'll go out and they're in the day-to-day. They have a lot of knowledge of what is, what's been going on in future repairs, and they're the ones talking to the vendors. What the board does, and what the treasurer is, they can, they're the ones who are able to take a step back and look at this more from a strategic point of view. This is one of the things seems to be an ongoing theme, and with the budget, it's not just a moment in time or even the year. There should be some sort of a strategic plan for what you want your association to look like in the future. What are major projects that you want to do in the future, and how are you going to be able to get there And that's something that really should come from the board level. And when I say it is a board, but then the treasurer really is kind of that liaison between the board and you know, putting together the budget. So I can't stress enough the importance of the treasurer just really being intimately involved through that entire process.
100% agree. We believe as Associa Gulf Coast that you, the board, this needs to be your baby, right? Because ultimately it is your budget. No matter what information Associa Gulf Coast, or quite frankly, any managing agent, regardless of what information we compile and we show you as the board for that budget, ultimately it is your budget. Now that is not us as Associa Gulf Coast trying to get away from your budget. It's not that at all. But ultimately, the decision on that budget sits with the board. So it is very, very critical in our world that the board, whether it's a finance committee, at the very minimum, the treasurer, be highly engaged in this process. But I want to tweak this conversation a little bit about something very rarely that is talked about, and I'm saying that tongue in cheek, and that's collections. In the world of coronavirus right now, and unemployment and all these types of things, there is a challenge in associations across the board, whether it's HOAs, condos, co-ops, mobile home parks, doesn't matter. There's a challenge right now going on with higher delinquencies. Now, that also is equated to bad debt and the bad debt expense. So could you kind of walk us through, Michael, a little bit about what should boards be projecting? Because you're not going to be, you, the board, you're not going to be able to ask Mr. or Mrs. Smith if they lost their job. You might hear it, or you're not going to ask them what their financial position is. You might hear those rumors. But from a budgeting perspective, from an accounting perspective, Michael, what should the association consider when they're talking about budgetary constraints next year for bad debt?
Right. I'm going to use the term that I think everybody else on this call has used, and that is it depends on the association and your the types of people. No, but in all seriousness, what I do is and what I think that that all that all boards should be doing right now is every month just looking at your collections and really looking at them to see what are the trends. I mean, maybe you do that, maybe not. Right now, it's really important to put under a microscope and look at the last 3 or 4 months and see where, look at all the different buckets each month and see, are these numbers going up? They probably are, and how much are they going up? And during this budget process, which is a 2, 3, 4 month process, really look at that every month, and then that's going to be one of the last numbers you're going to look at, because you're going to look to see how much is that going up, and then knowing that there could be a lot of people who this could have been artificially been stabilized over the last few months because of the unemployment insurance, and what happened to that? There is nothing in 2021, or we're not, the $600 is gone by then, and what is that number going to be? And nobody obviously is going to know the answer to that, but by looking at these trends and then overestimating what you would expect that to be, and whether it's 1% or 5% of your annual budget, 10%, it's really going to depend on what those trends are and your appetite for how conservative you are.
Now, talking about looking at trends and those types of things, that naturally lends itself to a discussion of a collections policy, your delinquency rates, your policies that your association has established. Now, the collection policies from a managing agent perspective, that's all we can go off of. And quite frankly, as a board, that's all you should go off of too. There should not be any Mrs. Smith or Mr. Jones have been here for 30 years and we're going to let them slide. If they're delinquent, they're delinquent. And that's from you looking at those trends, you're looking at the last 3, 4, 5, 6 months of these delinquencies. the easiest thing to do is treat everybody the exact same way. If you start wiggling on that as a board, quite frankly, you open yourself up to different possible challenges. And what I really mean by that is I want to bring Robert back in here on the insurance part. What kind of exposure, Robert, talking about the delinquency scenarios, if the board makes decisions that aren't consistent, meaning they're not treating everybody the same, what kind of insurance liability or exposure challenges might they run into in that event where they're making decisions that aren't consistent like that? And specifically, I'm talking about D&O coverage in general.
Yeah. So if there's no structure in place or kind of guidance in place, and you're treating one owner differently than you're treating another owner, then obviously there's discrimination that can be alleged as a result of it. And when you have alleged discrimination, then you're opening yourselves up to a D&O claim. And so obviously every association should have the D&O policy, and then there's a standard $1 million limit and a $1,000 deductible on that. But if you don't do it the exact same way for each member, then someone's going to catch wind of it, and they will take action against the association. And
to your point, we are we're number 47 in frequency, or number 3, I guess, in frequency of lawsuits here in the state of Florida. I like to use the example, anybody can sue you for just about anything. So if you're consistent as a board about your delinquency and collections, that's one thing you don't have to necessarily worry about. But frankly, you can be sued for just about anything. But Sheila actually brings up a good point regarding delinquencies and percentages as it relates to your financial position in the future. If you have a specific issue that you need money to get a loan. So Sheila, if I could I bring you in to kind of describe that scenario? What's the big deal with delinquencies and how it might affect you getting a loan, you, the association, getting a loan?
Yeah, thanks, Paul. Well, let's face it. What have you got to offer as collateral? The bills, things, and your assessments. Association loans are based on assessment as the collateral. So when you have a high percentage of people who are not paying their association fees, now suddenly your collections have gone up, you look less attractive to the bank as far as approving a loan, and the percentages are very low, Paul. They're very low. We want to see most of the people in the association paying their association fees, and you could be turned down for a loan, not approved, get less money approved. One thing you can do is start looking at, payment plans and which delinquent accounts is it time to go and see the lawyer about, and notice has been sent out, and are you following that process of noticing and taking action? So I would say that if you're looking at a new roof, or your reserve study says that you've got extensive restoration and you're now getting up around 11-12% in delinquencies, and you're going to have this shortfall, where are you going to get the money? You could special assess, but if the people aren't paying their fees already, do you really think you're going to have a lot of success getting this special assessment to make up for this shortfall? So a lot of associations will turn to a loan, but we'd like to see not a lot of people renting, not a lot of units owned by one person like a developer, and definitely we want those delinquencies low.
When you say low, and Sheila, I am not holding you to anything, so please, even though we're recording this, you're not on the hook for anything. But when you're putting a budget when boards are putting budgets together, naturally there's going to be a line, the quote unquote allowance for bad debt. It's rare association that has 100% pay on time. It's very rare. Are there some? Sure. Is that typical? Absolutely not. But is there kind of a guideline that associations from a bank loan perspective, is there a guideline that the association should use to kind of trigger what they should assume bad debt will be next year? Now, again, to use your point, is it 1%? Is it 2%? Again, not holding you to this, but just a general statement from the budgeting side. What should board members consider when it comes to the allowance for bad debt?
Well, I will tell you that actually it is less based on a number, a monetary number, and it's more based on the amount of people who are not paying. So look at it a percentage of who isn't, you know, in comparison with the number of units, what's the percentage of delinquencies to the number of units? Your allowance for bad debt, you know, when you have no cash flow and you're suddenly looking at, you know, and I'm not giving you a number, Paul. So, but I would say that you want to keep it down there very much, you know, in the single digits for percentages of delinquent, and your bad debt, how you're going to account for that. We'll look at the cash flow and see if it even makes sense to finance at that point. What's your payment going to be? How are you going to repay it? Are you anticipating a lot more of this delinquency in the future? And if so, what's that going to do to your maintenance fees? Are they going to go up? Are you going to start being non-competitive with other associations where they are paying their fees?
100% makes sense there. So as we wrap up this session, there's been an awful lot of information here. We've talked at length about reserve studies, certainly how insurance is being impacted in the budgeting cycle, absolutely on the tax side with Michael in his side of this world, and certainly with the financial side with Sheila. There's been a lot of information discussed, a lot of great information. I truly thank each and every one of you for your time and efforts. I also want to thank all the board members that are on the call, that were on the, and some even jumped off and jumped back on, so kudos to all of you. Really do appreciate the opportunity to get you more information. Part of Associa Gulf Coast, our role is to ensure that you have more information. That doesn't mean you have to be a client of ours. Don't get me wrong, we'd love for you to be a client, and you don't have to be a client of Centennial or Mitchell Insurance or Reserve Advisors or affinityCPA. But they are the professionals and the experts in the room that are ready and willing to help you in any of these questions and concerns that you have. Those of you on the call, you'll be able to get all this information. You'll be able to get these slides and all the contact information in front of you. I do also have some handouts that I'll be sending out in PDF form by email. Those will be coming out here in the next couple of days. That being said, I want to just wrap this up again by thanking Sheila and Robert and Matt and Michael for all their energy and their intelligence and, quite frankly, their valuable information to help you, your board, do the best job possible for your budgets. Again, thank you all, everybody. Thank you so much for your time. Much continued success. And for you board members, if you have any questions or concerns regarding your budgets and how the bank, your insurance, your reserve study, or your accountant, if you have any questions about that, or if you already have a vendor that you're using that you might get a question and just doesn't sit or feel right, feel free to reach out to these professionals. That is what we are here to do. We're here to help. Thank you very much, everybody. Truly, I wish you the best of luck in your budget cycle, and try and stay safe during these strange times. Thanks again.
Thank you.